Hello guys, welcome to a new video. I hope you guys are doing fine, and how has everyone been? Leave a comment below guys if you've been smashing the market, and how has your trading week been. So in this video we're going to be focusing on different types of structure: substructure, swing structure, retracement, complex pullback, all the stuffs guys. So if you've watched my previous video, I've explained the bullish market. If you haven't, just go to the channel. I have two videos I think explaining the types of movement in the foreign exchange market: the bullish when the market is going up, and then the bearish market when the market is going down, and then the consolidating market. If you guys are still having problems with market structure, understanding the bullish market and the bearish market, I think you should watch the video guys. I think I'll attach the link in this video. So in this video I'm going to be focusing on, I've explained pretty much how to identify the bullish market and the bearish market. So in this video I'm going to be focusing on types, complex pullback, swing structure, break of structure, change of character. That's what I'm going to be focusing on in this video. So in this, when the market is bullish, yeah, as I illustrated in my previous videos, when the market is bullish, the market is tend to create higher highs and higher lows. So your aim is to look for buys whenever the market is bullish. A new demand zone is created when the market breaks structure, which is correct. Every trader knows this. A demand zone is when the market breaks structure, and then this is going to be your demand. Just the basic market structure, guys. Yeah. Whenever there's a break of structure, and then whenever there's a break of structure to the downside, this is for the selling aspect. You also expect the supply zones to be respected. So in this video I want to explain to you guys what happens when market breaks structure. So as I illustrated in this example, the market just doesn't move like this. The market just doesn't move like this guys. The market is going to move in different forms and patterns. The market will not just break structure, come back. It's not that easy guys. If it was that easy, everyone is going to make money, and a lot of smart money traders think it's actually that easy, which means it's actually not that easy. So a lot of people, whenever there's a break of structure, they'll buy and then previous demand, so on and so forth, which is not how the market operates. The market is going to do something like this whenever there's a break of structure. Yeah, the market will not just come back and then, yes. So imagine if it was that easy, everyone would just buy. Like whenever the market breaks structure, everyone would just buy here, buy here, buy here, buy here, buy here. No, guys, it's not that easy. So now I'm going to illustrate to you guys how the market actually moves. So whenever there's a break of structure, which means when the market takes the previous high out, the market will then have to retrace. Okay, let me not overcomplicate this thing guys. So whenever there's a break of structure, if I could just make this bigger, I think I should remove this. Whenever there's a break of structure, the market is going to retrace back to a level of demand zone and continue its bullish movement. So whenever there's a break of structure, when the market is bullish to the upside, you expect the market to retrace back down and then continue the bullish movement. But oftentimes that's not what happens. The market won't just come down easily like this before going back up. No, that's not how the market works. The market is first going to do something like this, like this, create liquidity, build liquidity, induce liquidity, and come down to this demand zone, and then come back, then go back up. Entice early buyers here, give a small reaction, take them out, and so on and so forth. So when the market breaks structure from this level of structure to the new level of structure, this is what we call your swing structure, guys. It's called the swing high and the swing low. Swing high and swing low. Swing high and swing low is the low, yeah, to the high that breaks structure. Is as easy as that. So you are calculating the string structure from the low to the high that broke structure. As easy as that. So between the swing structure, the market is going to build up liquidity and take it out. The market will not just move like this after breaking structure, just move straight down and continue going up. No, guys, it's not that easy. A lot of traders often fall for this. That is why they're unprofitable. The market is going to build liquidity, build up liquidity, do something like this: high, low, build up liquidity here, give a fake change of character. This is a trap. Build up trendline liquidity, induce it, build up this liquidity like a triple low or trendline liquidity, induce it, give a small reaction, take it out, tap into the discounted zone and buy off. That is how the market works. So between the swing structure, between the swing high and the swing low, when the market is pulling back to the deeper levels of demand, it is called a retracement. And when the market is doing all this build up of liquidity and inducement of liquidity, it is called a complex pullback. It's a pullback that doesn't look simple like the way I illustrated. So I told you guys that when the market just goes like this, it's called a retracement, yeah? But it's actually not that easy. The market has to build up liquidity and take it out. So when the market is building up liquidity, engineering liquidity and taking it out, it's called a complex pullback. So people often get deceived, eluded, and start entering trades from anywhere. Meanwhile, the market is first going to retrace back to deeper levels before making its move to the upside. So all this is called substructure. All the structure that I'm saying here is called substructure. And from this high, from this higher low to this higher high is our main structure, which is the swing high and the swing low. As I illustrated in my previous videos, we have a new higher low and a new higher high. Those are our main structure. And then all this is substructure, all the structural points here, all these things. These are substructures. And this is all a retracement. This is all a pullback to this level of demand before the market continues its uptrend. As easy as that, guys. So the reason why market moves like this is just to engineer liquidity before tapping into deeper levels of demand and then flying off. So from this is how you use your Fib tool. So from your swing low to your swing high, you draw your Fibonacci tool. And by the way, if you want my Fibonacci settings, this is my Fibonacci settings. Maybe you should like take a screenshot of it. Yes, this is my settings. It's just 0, 50%, and 100. This is our discounted zone, and this is our premium zone. Anything below the 50% is a discounted zone, and this is where you should be looking for your buys from if we're in a bullish market. And we're in a bearish market, anything above the 50% is our premium zone, and this is where you should be looking to sell from. Look for buys at the 50% level, 50% of your fib level, and look for sells at the premium level, which is above the 50%. Let me illustrate a perfect example. If you go to the market, are you going to buy stuffs when it's very expensive, or when the price is very cheap, when it's discounted? Obviously you want to get the best price. The same thing with trading. You don't want to be buying price here when price is still here, when you still know price has to retrace back to the 50%. Whenever there's a main break of structure in the higher time frame, price has to do a 50% pullback before going back up. Guys, make sure you take note of that. Everything you see here is just price engineering liquidity for impatient traders, and which will eventually take them out. So price will have to always pull back to the discounted level before buying back up. This is where you will see all the institutions in. As easy as that, guys. So in a sell scenario, you want to be looking for sells in the premium zone. If you buy a land, are you going to sell the land when the land has depreciated and has no value, or you're going to wait for when the value of the land is very good and you sell at a good price? And same thing, you don't want to be selling here when the market is still in discounted zone. You are gonna get nuked. The market has to come to the premium zone before selling off. So I'm just illustrating to you guys how I trade. It's as simple as that, guys. The market is going to engineer liquidity. The market is going to engineer liquidity when price is still at equilibrium. 50% is equilibrium, and price will take out impatient traders before tapping into the discounted zone and buying off. And all this is called substructure. All this is called substructure. Our main structure is from the higher low to the higher high. So whenever you want to use your fib, you use your fib from the higher low to the higher high. It's as simple as that, guys. So let me illustrate an example to you guys. If you mark this thing out, this is a higher low and a higher high. So where is our structure, guys? As I explained to you guys, our main structure is from this higher low to this higher high. And then what do we expect? We expect price to retrace back to what? the discounted levels before buying back up, and then we'll use our fib tool, as I said, from this higher low to this higher high. And then what happened, guys? Price came to this discounted level, tapped into a level of demand. It's probably a level of demand on the high and on the lower time frame, and then moved off. So guys, as you can see, there were people that were trying to buy from this level here, and price gave them a little bit of profit and took them out, because price is not in a discounted area. As you can see, guys, I'll show you guys another example. You can see price is trading from this higher low to this higher high. So we'll mark out our fib tool from the low to the high. Now, what did price do? Price came to tap into the premium levels 50% before buying off. It's as easy as that, guys. And then price tapped in to this level of demand and then moved off. It's as easy as that, guys. Just make your trading very, very, very simple. There are a lot of checklists that you have to follow. So if you're looking for buys, you first need to identify your swing high and your swing low. You need to identify if price is at equilibrium, or if price is still at a premium zone. You wait for price to come to the discounted zone before looking for buys, and don't try and buy at premium zones or equilibrium zones. And then there are a lot of things that you still have to validate. This is just, we're trying to build our confluences. So we've spoken about swing high and swing low, how to determine our swing high and swing low, and substructure. So let me show you guys an example of substructure. All this is substructure. All this structural point you're seeing, it is substructure. Let's see, I'm marking it out. This is all substructure. This is when price is pulling back after breaking structure to the upside. As I said, as I told you guys, price will always pull back, which is often called a retracement, Price will always pull back, not in a line format. It's not just going to come back down. Like, if it was that easy, everyone is going to make money, obviously. Price is going to retrace back, build liquidity. As you can see, price is building liquidity, taking it out, building trendline liquidity, taking it out, inviting early buyers in before tapping into the deeper level of demand, then shooting up. So all this is a substructure. So substructure is important because you tend to understand who is in control. If buyers are in control, you are going to know. If sellers are in control, you are going to know from how price is retracing back to the premium levels, guys. It's as easy as that. So this is our substructure. This is our main structure, from the swing high to the swing low. And this is structure. When price breaks structure, price also is going to shoot off. It's going to retrace back to the premium levels, and then before shooting back up. I'm taking everything as easy as possible for every single person to understand, guys. It's as easy as that. I don't want anyone to complicate this. There are a lot of checklists, a lot of confluences that I look for before entering a trade. And the moment you tend to not trade until all your confluences are met, you are going to see how you are going to evolve as a trader. And this is what I'm here to show you guys. So in this video, I'm just going to be focusing on buys and showing you guys examples before incorporating the other things I do, which is still a lot. This is just a beginner level. I don't want to complicate anything for you guys. That is why I'm simplifying this. There's still a whole lot more, but I want you guys to take it step by step. I started with market structure, simplified market structure, the way every single person will understand. And then now we are moving up to understanding swing high and swing low, substructure, premium and discounted levels. How, if you don't trade at discounted levels, you are setting yourself up for stop loss. Do you understand? I illustrated an example to you guys. I just want to make you guys understand and learn how to read the market. As simple as that. I'll see you guys in the next video. And if, by the way, if you want to work with me one-on-one, you can book a call with me and join my free telegram for more updates. And please, please, please like and share and subscribe, so I'll know you guys are following and understanding what I'm doing. Thank you.